So did you know that most beginner investors fail? Not because they lack the money or even the intelligence. It's because they don't actually know where to start. And then what happens is they quickly become overwhelmed and they either just end up following or chasing the latest trend, or even worse, just sitting on the sidelines. Hi, my name is Simon. I'm a chartered financial planner, and I've helped hundreds of clients and their families get better investing and retirement outcomes over the last 3 decades. So if you're determined to start investing in 2025, there could be absolutely outstanding opportunities out there, but only for those who understand how to crack the investing code. Now, there's a simple, proven strategy that's used by professionals like myself that the complete beginner can also use to start building their own wealth today. So in this video, I'm going to show you exactly how to get started, where to invest, why it's important, and why delaying could be even more costly than you can possibly realize. Welcome back to the Personal Finance Crew. And if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. So let's go for a walk together. I'm going to share with you some of the easy steps to follow to help you get started. So I'm going to see you all in a minute. So investing in 2025 might feel very overwhelming and a daunting task for anybody, let alone a beginner. There's endless advice on social media as well as on YouTube, and there's lots of complex jargon, there's ever-changing financial markets, and there's news channels all the time which seems to be focused on the negative and almost like we feel that the world could end at any time. So it's easy to put off getting started, but here's the absolute truth. The sooner you get started, the better. Now, we've all been where you are, so you're not alone, that I can promise you. Why do you need to invest in the first place? Well, when you're thinking about investing, it's always easier to have the end in mind and then work backwards. There's going to be many reasons to invest, but a simple answer and an honest answer would be to grow your wealth over time and make your money work hard for you as you've worked hard to get the money in the first place. Now, don't forget that 34% of adults in the UK have either got no savings at all or they've got less than £1,000. So make sure you get your emergency fund in place even before you consider investing. We could just put our savings in the bank or even under the mattress, but that would mean that the buying power would be eroded over time due to something called inflation. Inflation is often called the silent killer or the silent thief of our wealth, as it eats away at our purchasing power and our savings over time. Now, in the UK, inflation, especially in recent years, has averaged around 3%, but spikes clearly can occur. I mean, just look at the soaring rates that we've all been through post-pandemic, which reached a peak of 11.1% in October 2022, and that was the highest that we had in over 40 years. Now, if you keep your money in a bank account earning a minimal amount of interest, you're essentially losing money over the long term each and every year. Investing allows our savings to outpace inflation and to create long-term growth. Charlie Munger was Warren Buffett's business partner for a long time, and he said, the big money is not in the buying and the selling, but in the waiting in between. For instance, an index fund which tracks the FTSE 100 or the S&P 500 typically can offer annual returns of around 8% over the long term. Now, our friends at Vanguard have projected that the average long-term growth is going to be more closer to 6%, which is the midpoint on this chart over the next 10 years. But clearly that's going to come with some big highs and some big falls too. While clearly there's going to be risks, the alternative, which is doing nothing at all, is a guaranteed loss of value. Now, the investment world was revolutionized in 1952 when someone called Harry Markowitz created the concept of diversification. And that allows you to manage your risk and is effectively your safety net. Now, think of this as not putting all your eggs into one basket. He actually went on to say that diversification is the only true free lunch in investing. So by spreading your money across various asset classes, sectors, as well as countries, you're going to reduce the risk of a single poor investment derailing your entire investment plan and your portfolio. So in 2025, diversification is even more critical than ever. Markets are ever more connected than ever before, and shocks in one sector, like tech layoffs, for example, an energy crisis, or political uncertainty, they can ripple around the world in milliseconds. So when it comes to any kind of investing, you need to keep it simple. A diversified portfolio might include, for example, stocks and shares, and you may have those for growth and for dividends as well. You might have government and corporate bonds, and these could be for an income payment, but they also tend to move in the opposite direction to stocks and shares. So if stocks and shares are temporarily falling, then bonds tend to rise and vice versa. This is going to help protect you in times of volatility and uncertainty. You might also have some commercial real estate for rental payments as well as capital growth. Now, you also might have commodities like gold, which acts as a hedge against inflation, and gold is close to all-time highs. You also might want to consider multi-asset funds, which are a pre-selected mix of bonds, stocks and shares, and investments tailored to balance to meet your existing risk profile. Now, multi-asset investing is where you invest in funds that are already diversified, and they could be a great choice for beginners. So now I've looked at why we need to invest and what we can invest in. So let's now have a quick look at how we can get invested. Well, unfortunately, it's not quite as simple going online and buying a share from the company that you want to buy in. We actually need to buy shares via a third party, via a broker. And normally today, that's all done online through what we call a platform. Now, the UK offers a huge range of investment platforms that make getting started very easy and straightforward. Here are some options for beginners. We've got Hargreaves Lansdown, Free Trade, Vanguard, AJ Bell, Trading 212, Interactive Investors, but also your bank might have an investment platform to take advantage of as well. So you need to look for platforms with low fees that are easy to use, easy to understand, and perhaps offer some educational resources as well. You might also want to check that they are FCA regulated, and that will protect some of your investments as well. Now, many beginners will choose a general investment account, but these are not the most tax efficient nor the most tax advantaged. And here's why. And that's simply because beginners aren't aware of the capital gains tax rules wrapped around any gains that you might make. Now, the UK's CGT allowance is just under £3,000 a year. This means that any gains above this amount is going to be taxed under the new rates which were announced in the budget at the end of October in 2024. So what that means is from April 2025, if you're a basic rate taxpayer, the capital gains tax that you're going to have to pay is rising to 18%. And if you're a higher rate taxpayer, this is going to increase to 24%. Now remember, if you're fortunate enough to make really big gains, these can take you into the next income bracket, so be careful. Now, to put that into perspective, the government collects about £14.5 billion each year from around 370,000 people. So to combat this tax, you then need to consider the following. You need to consider using your ISA, where you can save up to £20,000 tax-free annually, or even consider using your pension, where you can save up to £60,000 gross each tax year from all sources. Now, both of these options are going to allow your investments to grow completely free of capital gains tax whilst they're invested. So if you're not sure which option you prefer, whether it's an ISA or a pension, I'm going to link a video at the end of this which explores the pros and the cons of both the ISA and the pension. Now remember that tax efficiency make a huge difference in your overall returns, so it's really worth planning a long time ahead. So if you're finding value in this video, please stop and hit the like and subscribe button so you can join us on our journey to build this financial community to over 10,000 subscribers. And remember to hit the notification bell as well, so you're not going to miss any valuable content throughout 2025. Now, unbelievably, this is our 50th video in 2024. So we're looking forward to the next 50 videos in 2025, and you hope you'll join us along the way. Now, you're also going to hear a lot about active versus passive investing. Now, active investing involves a fund manager selecting individual stocks or funds, trying to time the market to outperform the relevant benchmark. But this often comes with higher fees and unfortunately inconsistent results. For example, Morningstar found that 90% of active managers don't beat the relevant benchmark over the long term. Now again, this is due to some higher fees and charges, and of course active managers can also get it wrong. Passive investing through index funds, these simply track the market and they offer lower costs, full diversification and market returns, making it a sensible choice for many beginner investors. Now this led to Jack Bogle, who is the founder of Vanguard, to make the very, very famous quote, "Don't look for the needle, just buy the haystack." Now in this instance, he's referring about how it's very difficult to consistently buy winners, and sometimes it's just simply to buy an index fund which tracks either the FTSE 100, for example, in the UK, the S&P 500 in the States. Now, for example, the FTSE All World covers 4,242 different companies across 48 countries, and that represents between 90 and 95% of the world's company value. Now, that is a very, very big haystack. Now, fear and greed are perhaps two of the biggest enemies of successful investing. In 2025, as markets remain volatile, controlling your emotions is going to be absolutely critical. Now with fear, market dips are absolutely normal, so don't sell in a panic when prices drop, as this is going to lock in any losses. You need to stay focused on the long term. With greed, chasing skyrocketing values and prices of trends, and this can lead to very, very poor decisions. You need to stick to your plan even when you're tempted to make very quick gains. Please do not follow the herd. And number 3 on this list is language. Now, language is really, really critical. You need to remember that your investment has not lost money if you're investing for a long term. It might have fallen in value, but it's highly likely to recover, and that's a big difference. Now, this chart on screen is going to show you the full range of emotions which you might experience as your investment rises and falls over time. Now, as the value rises, like fund values have done in the past 2 years, you're tempted to enter a stage of euphoria, and you might want to invest ever greater amounts of money and take even more risk to reach your goals. But clearly, when the investment then starts to fall in value, you're going to get progressively and more negative and possibly capitulate and sell out before the cycle then starts all over again. Now, this behavior is clearly going to affect your investment decisions, as 50 years ago, the average holding period for a fund was 5 years or more. But now it's down to about 10 months, and in some cases, perhaps even as low as 6 months. And this is due to many people wanting to get very, very quick results, and they are not comfortable clearly when markets fall. Now, some stock markets have increased by over 50% in the last 2 years, where company earnings, on the other hand, may have increased by on average about 7%. What that means is investors now are paying ever higher prices for future earnings of companies, and that makes markets and companies overheating, and perhaps the valuations becoming a little bit frothy. In fact, the share price to earnings now is amongst the highest on record, and it's probably the 3rd highest they've been in the last 50 years. It's also important to understand that ever since 1926, which was before the Great Depression of 1929, the S&P on average has increased and been positive 75% of the time. So yes, clearly there's going to be times when markets fall, and they can be stagnant for many, many years as well. But I'm often asked by clients about the risk of investing. Now, of course, there's going to be a level of risk, but in my opinion, the risk really is about the uncertainty of your returns and the performance of your portfolio, but only in the short term. If your time horizon is going to be 10 years or even 15 years or longer, then the probability of making money increases dramatically from around 95% for 10 years to 99.8% over a 15-year period. So what's the best way to manage your emotions then? Well, the quick answer is to automate your investments. So what you need to do is set up a regular contribution, either by a direct debit or something similar, and then invest that money into your ISA, your pension, and your diversified funds. This ensures that you stay consistent regardless of what's happening in the market. Now remember, this drip feeding of your investments is going to smooth out any volatility and allow you to buy quality companies at discounted prices. Now, of course, I can't have a 2025 investment video without mentioning crypto. And that continues to lure beginners with promises of riches. But 95% of the investors into crypto do not understand the underlying technology behind them. So whilst blockchain technology has real and massive potential, most crypto investments rely on speculation rather than the underlying value. Now, this aligns with something called the greater fool theory. And this is the idea that you hope you can profit by selling an overvalued asset to someone else who's willing to pay even more, the greater fool. Now, this happened in the South Sea bubble in 1720, when the frenzy around this trading company increased the share price by about 800% in just a few months. Now, this led clearly to not only financial ruin, but a distrust in financial markets in general, as well as accusing politicians of insider trading. So does any of that sound vaguely familiar? This greater fool theory works until it doesn't. So many investors in Bitcoin, Ethereum, or meme coins have experienced significant gains, but sadly some devastating losses as well. So if you're drawn to crypto and you need to scratch that particular itch with your investments, please treat it as an unregulated, high-risk gamble and allocate no more than 5% of your investments to this type of asset. What we need to do is focus the bulk of your investments on proven, long-term assets such as stocks, shares, bonds, and index funds. You need to also remember that any crypto gains are going to be taxed as capital gains tax, as high as 24%. Now, one of the biggest myths about investing is that you need a lot of money to get started. And really, that couldn't be further from the truth. In reality, starting small is fine. What matters most is consistency. Now, thanks to the magic of compound interest, even modest investments can grow significantly over time. For example, if you're investing £100 a month into an index fund, earning 7% annual returns, this could grow to over £40,000 over a 20-year period. So starting earlier is going to give you and your investment more time for growth. So here are some key steps to get started. Set some clear goals, understand your risk tolerance as well as your time horizon, choose the right wrapper, such as an ISA, a pension, or a GIA, pick the right platform from some of the ones that we discussed earlier, start small and stay consistent. Some final thoughts. Investing in 2025 doesn't require a finance degree or even a lot of money for that matter, but it does require commitment, patience, and a willingness to learn. Now, of course, we all know that the hardest part of anything is getting started. So take that first step today, and 2025 is going to be the year that you manage to crack the investing code. So if investing in 2025 is going to be your next important step, then you might need to understand more about how to select the right fund for your money. And there's a simple red step method which I use, and I've included that in a link to the end of this video. And also, if you don't know whether you want to invest in an ISA or a pension, I've also got a video on that too. So thank you so very much for watching to the very end of the video, and as always, for your time and for your patience. And we'll see you all again next week.